How to easily find cheap options using the trade lot value, why I keep buying volatility despite the summer months and the lull, and the traditional breakdown of an option strategy for the week. Hello friends, this is the Options channel and I'm Roman Sadovsky. Today, as usual, we'll look for Bitcoin options that are profitable for trades and where you can make some money. And look, right now the market has entered that typical summer lull, and basically you can see that Bitcoin is gradually consolidating, right in this range, roughly from 68 to about 58, and it turns out it's been consolidating here since June 26th. So at this point, it's been almost a month already. So I think in 5 to 6 days, it will be a full month. And actually, this consolidation could turn out to be quite good, because it turns out that despite all the fears and concerns that Bitcoin would drop below 60, it still hasn't. And here it's obvious that some buying is happening, meaning if Bitcoin had easily broken through this level, it probably wouldn't be staying here. And usually, most often after a sideways movement, a pretty good reversal can happen. And as I've said more than once, it's been a very long time since there was a good trade for growth in BT coin. That is, call options are still super cheap, so I believe that after this consolidation, we have a good chance to see some decent upward movement. And look, here's what I wanted to show you today. How to easily determine whether options are cheap or expensive. So here I have my table that I put together. These are the regular weekly options, the shortened ones, which I trade from Sunday to Friday. On Friday, we have the expiration of the weekly options. And so the reason I buy on Sunday is because on Sunday, options are much cheaper than if you buy them on Friday. If you buy from Friday to Friday, then the option prices include the full week. But if Friday passes, often Saturday and Sunday are not counted as full days. And that's why, for example, buying options after trading on Friday will be much cheaper for the week than if you buy them including Friday. That is, it turns out that we are buying options at about 1.5 to 2 times cheaper because almost 3 days drop out right away. That is Friday, Saturday, and Sunday. But if you buy on Friday, then you pay for all 7 days. And now look, here is my table with the option prices. More precisely, not with option prices, but with the changes for these expired weeks. And what do we see now? We see that at the moment, if we look at the overall average closing price, for example, for the last, let's say, period of about 24 weeks, that would be the average closing. So here's exactly what we have found. Once again, after conducting a thorough and final review of all the data points collected, the total number has officially reached 24, which confirms that we have successfully attained the absolute maximum count possible for this entire operation. So the average is 3.9%. That is, on average, the market moved 3.9% from open to close over the last 24 weeks. So even if we don't do anything with options and simply buy both sides, if we can buy options for less than 3.9%, then accordingly we will make a profit if the market moves outside this range. And now I'll show you what I mean. I have already successfully loaded all of the historical data into the backtester, and the backtester is now showing me the following results. Look, it turns out that at this exact moment, let us go ahead and load the current market prices. What do we see? At the moment, the call option at 64,500 costs 1,070, and the put option costs 915. So if we add up the cost, it comes out to 970 plus 1,070. That's 2040, and if we divide 2040 by the current price of Bitcoin, which is about 64,700, we get 3.15%. So if we plot these same 3.15% on the chart here, so starting from our current level, we have 64,610. Now, if we calculate an upward move of about 1,900 points, that gives us a target of around 66,400 at the very top. Because of that, let's go ahead and set our level at 66,400. Looking at the downside risk, if we subtract that same 1,900 from our base, we get 62,700 or roughly 62,600. Regarding the timing, the expiration of the current weekly options is scheduled for next Friday, which is the 24th of the month, exactly at this time. And look, what does this mean for the options? At the moment, you will profit from options if the market can break out of this very narrow range. In my opinion, that's very cheap. And even if, judging by the chart, it might seem like it could stay within the range, well, why not? But if you look at the table, look, here we have the movement from the open to the maximum, meaning how far the market moves to the extreme. And let's see, how often has Bitcoin actually moved less than 3.1% in general over, say, the last 6 years? So here, look, it's more here, it's at 3.13, but here, yes, here, indeed, it didn't break out. So basically here it closed at 1.98, and in that case, yes, you really could have made a profit. Here it moved 3.87, here it moved 9, here 5, here 3.5, here 17, here 4.9. Here it didn't break out, 3.2, 5.3. And so, for example, if we just take all the weeks, it turns out that since 2017, we have a limited number of such weeks. How many? 498. And let's just take a look at how many weeks we had where the movement was less than 3.15%. It is currently estimated to be less than 3.15% of the total amount. Not here. I am so sorry. Let me check. That would be 3.12, if I am remembering that correctly. And look at what we have left. So it turns out there were a total of 400. And there were only this many narrow weeks, just 41. So less than 1 in 10. So it turns out that less than 1 in 10 weeks move less than what the current straddle is priced at. Straddle? So there's a 90% chance that you will be able, at least during the week, to have the opportunity to close this straddle you bought for a profit. And if we see that, for example, on average, the closing in percentage terms, let's say, as I showed for the last, so yes, you see, if we redraw for the past weeks, the average closing is 3.68, while the cost of our straddle is 3.15. So it turns out that if you do nothing at all and just buy a straddle, on average it will close about 0.45% higher than what you spent. And in this case, the options are considered cheap. If, on the contrary, for example, you see that the straddle costs, say, 6% and the market on average moves, let's say, 5.5, then the straddle is expensive. In that case, it makes sense to consider maybe selling something. And actually, this simple method is much easier than, for example, looking at the implied volatility chart, because implied volatility is, after all, an abstract value and is unclear to many people. But here, it's very straightforward. So we just look at the Bitcoin chart. For simplicity, let's say we set it to weekly, and we look at how much on average the price moves in a week. So for example, the last week moved 1.28%. Here it's 0.22%. So yes, these are very narrow weeks, but here it's already 6.8%. Here it's 5.9%. Here it's 3.7%. Here 3.8%, 14%. And so for example, this week with a 14% move, the options cost about the same. So if you remember, I bought my options right around when Bitcoin was at this level, right here. That is, this isn't Bitcoin itself, but the price of options on Bitcoin. So it turns out you could have bought for the same 3%, and if Bitcoin moved 14% in a week, such a trade would bring you a 4 times return. And even according to the backtester, you can actually see that when we buy a straddle, we have a win rate of 53%. But here's what's interesting. So first of all, at these option prices, our win rate is just over half. But at the same time, notice that the maximum you can lose is 3%, 3.1%, while you can earn up to 31%. So what does that mean at most? We can make 10 to 1, and at the same time, we win more than half of the trades. And in moments like these, I just can't help but buy volatility, because you realize that even the silliest event, I don't know, like Trump releases a new coin or says something else, like he starts a channel that charges $1,000 just for posting his messages a bit earlier, and Bitcoin can easily give us those 3.5%, 4%, 5%, or even more. So it turns out the risk is small, meaning you can make 3, 14%, or even 1 to 10. Plus, I usually buy options further out, so the multipliers are actually even bigger. And notice also the maximum losing streak, so at most, 8 weeks when the market was completely flat and going nowhere. And take a look at how beautiful the chart is. So with this method, you just go and open, for example, buy bid, look at the weekly options, and here you simply take the central price, $64,600. So here it's $945. You add that to $1,045, which is the cost of the call and put. And you can even do this directly in buy bid, for example, in the position builder. Let's open the position builder. And right here, for example, we can simply add 1 or 2 extra options, or perhaps just 1 single option. Let's make it 2 for the date of July 24th, for this very week. All is good. And here, right on the chart, that's exactly what it shows you. So unfortunately, because of that, it won't work out. Yes, well, you could have seen it here, but unfortunately, Bybit changed the visuals. By the way, maybe I can do this in my backtest. So let's try it here. Yes, it'll actually be even easier here. And look, if we just do a buy straddle here, so we just need to select the date, July 24th buy straddle. And here it's clearly visible, you see 62,470 and 66,500. So you can see right here, here's the chart, here are our dashed expiration lines. And if, for example, we get a week like this one here, and the market moves either here or here, you can see that the maximum you can lose here is exactly $1,750. But if it moves significantly, let's say outside the corridor, if it goes somewhere over here, then you'll get plus $5,000, and here it turns out you'll get plus $4,000. And here it's very clearly visible when we have this kind of vertical display with the P&L chart rotated 90 degrees that it's very easy to evaluate option prices this way. So we take the central straddle, and from it, as well as from the chart, it's clear where we have profit, where we have loss, and what needs to happen for us to make money. So we've figured this out, meaning we've seen that we have cheap options. Now let's continue with the usual plan. We'll review the previous trade, then look at the forecast and what to expect from this week, and finally we'll put together an options position for this week. I'll say right away that I plan to buy a call option closer to the money since I believe the market could rise significantly, but just in case, I'll also take a put option in case this consolidation breaks downward, in case they do break down after all. Alright, let's get started. So it turns out that the previous trade, I bought those very 58 to 68 options. They cost me a mere $125 each, and as a result, I've lost at the moment 0.6%. And the profit chart currently looks as follows. As I mentioned, it's a classic volatility purchase, and we're gradually sliding down. If a significant move happens right now, I think the profit chart could immediately rise much higher, above this level. So it turns out that last time we took the 58 to 68 range, and it cost us $125. Now, let's see what we can expect from the market. So on the 4-hour chart, we can see consolidation. I think there's a high probability that we'll break out of this consolidation quite strongly. To be honest, I think there's a better chance it will go up because we haven't seen growth in a long time. And I believe that we can quite possibly break through the upper boundary at 68. So if we break through this narrow area right now, I think we could very well move somewhere at least to the area of this previous high, which was at 67,440. Actually, it would be good to reach the upper end of this consolidation, which is around 72,800. And if we suddenly go down, I think here you can treat this as a kind of insurance, just in case of a black swan event, that is, if something really bad happens. I believe you should take this boundary at 58 and simply have this option in case of a sharp collapse. So I'm not expecting it, but as usual, you never know when another black swan might appear. Therefore, my forecast is that either the market could go above 58, so in this case, I need the market to move somewhere around, well, a bit more than 6.5% upwards, or below 58. In this case, I need about 11 to 12%. By the way, the two scariest weeks we had this year, the market dropped by more than 15%. So basically, if a real crash does happen, I think we could actually see around 54, maybe 53. Well, it all depends on the degree of the black swan event. For now, in general, I'm leaning more toward the upper boundary having a higher chance of being broken. Alright, let's move on. Let's see what else we have. Looking at the current open interest, if we take the Deribit exchange, we can see that most of the open interest is there right now. Let's estimate $100 million, and for September we have about $200 to $240 million. That's the total put market value and call market value. And for December, it turns out that December now has the largest open interest at the end of the year. And it's actually interesting to see what they're expecting by the end of the year. Let's take a look. So let's first focus on December. For December, the range is quite wide. That is, for December, it's clear that the market could easily reach 80. It could also go down with the lower limit somewhere around 60. But if we break through 60, then we could probably head down to 40. Alright, so we've established that here. Next, let's look at September. September is a bit tighter, but you can also see that we have 78. By the way, why 78 and not 80? Probably at some point someone accumulated calls there. The second level is 75. So basically, I think that taking into account these two big bars around 75, in my opinion, by September, it's quite possible that if we stay in a sideways trend and then bounce a bit, we could close the quarter somewhere around this level. But if we go sharply down again, then here you see these bars. If they get broken through, then Bitcoin, of course, could drop very hard. But for now, again, I don't see where that would come from, because it seems like everyone who was really scared has already sold. Only if Michael Saylor, for some reason, decides to sell his Bitcoins, but I wouldn't count on that. So, that's what we're left with. The nearest month for us is July 31st. Well, here, basically, there's a big bar at 70. In reality, you can pretty much see that there are no positions. That is, almost no one has opened any positions for July. But at the same time, there are these two big interesting bars. I think that most likely by July 31st, it will close below 70 because I've rarely seen otherwise. And these are definitely not any kind of insiders, which gives these bars the opportunity to shoot up. It's actually very interesting. To be honest, it looks like maybe this really is some kind of insider move. Maybe at this moment they'll push it above these levels. They know it'll go up to 75, someone will unload here, and then it'll come back down. But again, this could just be my imagination. It just seems a bit abnormal to me. So it's not Popov or Nikolov, but there are these interesting positions. This is what's happening with open interest. Now let's look at the option prices. I've already shown through the Straddle why I think it's very cheap, but just in case, I'll also show it using implied volatility. If we take the weekly implied volatility on Bitcoin, we can see that right now we are near the minimum. In other words, we've almost reached the same lows that we had at the end of May before the jump from 72. That was somewhere around 58. So once again, options are super cheap. Alright, we've covered options. I also wanted to show something regarding greed and fear. Right now we're in a kind of neutral situation. You can see that the fear is quietly fading away. Yes, it's still there, but it's not as intense anymore. So we're already approaching a neutral position. In other words, the market has mostly calmed down now, especially considering that option prices are also cheap. And let's move on to the options position. So let's open the backtest up. So what I showed was that the straddle is cheap. And now let's set up this position. I assumed that the market could be above 68, so let's add from 8. The option currently costs $105. As you can see here, we get a truly impressive and clear maximum. By the way, it's interesting. So the maximum for Bitcoin, it turns out, for 24 weeks, it couldn't grow to 68, and now it's up by 6% at once. I think it was somewhere around here. It seems to me it was right here. Or maybe it was here. There wasn't full growth for 24 weeks, and now it's the same. I think it's about the same amount, but at the same time, the chart will look good, so we add it to the portfolio. I've added it, and also another option just in case, as I mentioned, of an Armageddon or some completely unpredictable events. I want to pick something cheap so I can buy a lot of them. In other words, specifically for a Black Swan event. Number 58, for example, costs us practically nothing, just $25. So what's interesting is, for example, if we look at it in a backtest, the maximum we can lose is minimal, 0.04%, while the maximum profit was 25%. So if you divide 25 by 0.04, well, let's say with commission included, 0.05%, then it turns out at 5 times, that's 0.025. At 50 times, that's 2.5. At 500 times, that's exactly 25%. So historically, this kind of option, if some kind of catastrophic event happens, could increase in value by 500 times. In my opinion, that's fantastic. It turns out that a single trade like this could make up for 10 years of losses, and we'll add this one to the portfolio as well. You can see that we end up with an asymmetric position, since the current market is at the 64,600 level, so a nearby call option, as I'm expecting growth, and a rather distant Q58 option in case that very crash happens. Now let's estimate the risks. What are our risks? If we take, as shown here, 1.5 options each, then our risk will be $226. $226. Small risk, the option prices are good, so we can actually take a bit more. Well, for example, let's say 6 each. Let's see what the risk would be for 6. $877. In my opinion, we can even add a little more, say 7 each. At these prices, honestly, I understand that even if I don't hold until the end of the week, if the market just shoots up, I can just lock in part of the profit. I'll take, as you can see, the company for sale, 6.9. I'll take 6.9. I want to stay within $1,000. No, 6.85, then 6.8. I'll take 6.8 options. Yes, it worked out. I managed to fit within the limit, including commission. That's $994 and the rating for the week. So with this kind of asymmetric strangle, I'll go into this week because I believe the options are really cheap. And of course, I expect that the market could move quite well upwards. As I've said many times before, I'm expecting a move of about 12%, so I figure that this position could bring in, let me see, 12% would be about roughly 7,200 from the current level, meaning the market could go up to around 71,800. By the way, technically that also lines up. If the market goes to 71,800, then with a risk of $1,000, that would be a plus 25. Honestly, it looks absolutely fantastic. So if that happens, I guess we could wrap up the experiment, because then we could honestly say that the Black Swan idea has proven itself. The strategy works, and it will always work. Because if there's one thing for sure, is that the world remains unpredictable. And even if nothing happens for 4 years, that doesn't mean something can't happen at any moment. Overall, I really like the risk-reward ratio. Well, friends, I'm glad you watched the video to the end. I'd appreciate it if you support me with a like and a comment. And let me remind you that all these videos are not individual investment advice. You make all trades at your own risk. Just in case, let me remind you that I take risks very carefully. That is, as you can see, my maximum risk per week never exceeded 2%. And since the risk is calculated as a percentage, even if there are an infinite number of regular trades, thanks to compounding, I will lose less and less each time. In other words, there is no way to lose the entire deposit. At the same time, any black swan event, as I showed you, a single black swan can bring 500 times returns on options. And accordingly, all these struggles, doubts, and difficult emotions will, as they say, be offset by this profit. Although, to be honest, you can't get your peace of mind back. Thank you, friends. See you in the next video on Sunday. This was Roman Besedowski. Bye.